All right, so in the first part of the video for chapter 2, as well as in worksheet 1, you were asked about the normal balance of accounts. You can also see this in your textbook on page 61. You can kind of see that in action as well. The purpose of this is to kind of so we can really start to do this in a more condensed format, and you'll see how that works. Again, we're going to start by showing you the same 9 transactions that we watched in chapter 1 videos, the same ones, and we're going to give you the asset liabilities equity, the accounting equation effects of these transactions, and then we're going to show you another way to record those transactions. It's the same idea, the same story, just a different way to record the transactions. Here you see our transaction is that the owner of the business added some money to the business, an equity investment in the business. And before we had a a cash increase of 30,000 and an equity increase of 30,000. So we're going to do that in a different way using our debit and credit rules we just learned. Cash increased, and so that means that we're going to debit cash. Again, because cash is, as the screen says, because cash is an asset account and it's going up, we're going to debit that account. And so cash is part of our entry. Common stock is the other part of our entry. Common stock is on the right side of our T. It's a natural credit balance. And so increases are credits. And so you can see this works out. Both accounts are increasing. One account increases with a debit. The other account increases with a credit. And so we end up with what's called a journal entry. This is our first journal entry you've probably seen in the class, unless you've been obviously in your textbook. But you can see a couple things. First, the date of the transaction, and you can see the names. Note the debit account is first, the credit account is second, and typically the credit account is indented as well. And then you can see obviously the numbers on the right side as well. In this case, there's an explanation to your journal entry. But this is essentially how we will be recording transactions going forward. Again, it's a neat, elegant way to record the transaction. You can see that this is going to fit easily on a page, a bunch of transactions, or you go down the page. Instead of our horizontal and vertical space that we used for all of the transactions we did in chapter 1, this is basically just going to go down the line and down the page. In addition, you can see our T accounts. If we were going to post these in the accounts, you can see the cash account has 30,000 in it, and the common stock account has 30,000 in it. And again, they're on opposite sides because of the natural balance difference between cash, which is an asset, and common stock, which is an equity account. So you have to be a little bit flexible because some of these accounts are going to increase with the debit, some are going to decrease with the debit, and so you have to be a little bit flexible with this. And you'll see this as we go. Transaction 2, purchase of land for cash. This is what we did in chapter 1. You saw down here on line 2, minus 20,000 in cash and plus 20,000 in land. And so we had both parts of the transaction on the asset side of the equation. So this is going to be a little bit different. So in the first transaction, we had cash debit because cash went up. But in this case, cash is not going to be debited because cash is going down. There is an asset that's going to be debited, and that's the land account. Land is an asset. Land is the asset that's increasing, and it's going to be debited. Cash, however, is an asset that's decreasing, and so it's going to be credited. You're not always going to be debiting assets. We're also going to be crediting them because assets are going to go up and assets are going to go down. And so that's what's happening in this example. One asset, land, is increasing by 20,000. Another asset, cash, is decreasing by 20,000. Another thing to note, and this process is called double entry accounting because every entry has at least 2 parts to it. And so the key to that is we have to have at least 2 accounts in each entry, and the debits and credits must equal each other. And so if you have an entry with 10,000 in the debit and 20,000 in the credit, that's not going to work. The debits and credits have to equal each other. And here you can also see the T account posted. Look at what happened to cash. Cash had a $30,000 balance in it, and we're not decreasing it. There's no minus here. We're just showing the minus by crediting that account. And then the land account, you can see the debit of 20,000. Next one, purchase of office supplies on account. Again, this is what we did in the chapter 1 example. We had office supplies increased 500 and accounts payable increased 500. Office supplies is an asset. Assets have a natural debit balance. And so we should be with debiting office supplies 500. Accounts payable is a liability account. with a natural credit balance. And so we're increasing that account also with a credit for 500. And then we can see our posting here. Again, all we're doing is looking at the same transactions that we looked at in chapter 1, only instead of looking at them in the respect of the accounting equation, we're using debits and credits instead to enter these entries. We're going to take a break now, and then we're going to come back and do some more transactions before we do our next set of worksheets.